So delighted to now have a full panel with us today. We have Anthony, Hassan, Scott, and Daniel, and we're going to have a great discussion on interoperability, P2P, and thinking about really where we're going in the future, which is something that was discussed on the last fireside, but I think we're going to look far in the future as well on this one. So let's kick things off and get right into it. Now, Anthony, we have exchanges and venues that think they have enough critical mass to sort of take over the world and be the only next big thing in financial services. But if we're really looking at, private market assets, no one actually has more than a few percentages. And so how do we join up those pools of liquidity? And more importantly, maybe what happens if we don't?
Yeah, thank you. So we're at a really interesting time in the industry, I think. We've had this tokenization technology for a few years, and it's been embraced by many institutions and digital leaders setting up digital exchanges, etc. And lots of assets are now being tokenized, I would say, to the extent that we almost have an oversupply of tokenized assets. But the issue everybody started to run into is, okay, that's great. But how do you bring market participants together, and how do you achieve a market-wide level of distribution? Because ultimately, it's not about the asset, it's about the client that wants to invest in the asset, right? So it's how do you get an environment where investors, wherever they may be, can access assets wherever they may be? And personally, I don't think that's going to work in an environment where you're asking the investors to onboard and KYC where all the assets are that they want to get access to. So I think there are exchanges out there, and I don't think all of them think they're going to take over the world, but I think there are exchanges that are starting to get a level of traction. They have assets and investors. And we have large institutions now distributing tokenized assets. But ultimately, I think all of these entities understand that they need market-wide scale of distribution. You're never going to get enough assets and enough investors in one environment to achieve scale and liquidity. In fact, finance doesn't really work like that. You actually, the assets get represented by institutions, issuing agents. Investors, the ones we're talking about, could be very sophisticated, accredited investors, but they don't want to know about technology. They connect through their wealth managers, hedge funds, private banks, etc. And through them, they get access to the investors. So I think it's opening up this distribution is about how do we take all these environments, call them pools of liquidity, and how do we connect them together? And we firmly believe at Onera that, and we've seen this pattern in capital markets historically, is you want to start to connect these pools of liquidity peer-to-peer. And if you can connect them peer-to-peer, you're not creating one centralized venue in the middle of everything. It's not going to work like that. But if you can connect these pools of liquidity peer-to-peer, whether they're exchanges, whether they're large institutions issuing, distributing assets, and whether they're large pools of investors, if you can connect them peer-to-peer, then you can start to unlock this space at a global level. And so we think that's the way to do it.
Well, we did hear someone say earlier today that interoperability is solved by Onera, so maybe.
It is.
So turning now, thinking about both the old and new world here with JPM and Coinbase. So thinking about what you've said, and if the ecosystem does continue to evolve in this way, let's think ahead sort of 50 years. So nobody's going to come back and quiz you on this in next year's panel. But if we think far in the future, what's the kind of ultimate vision that we're working towards? And also, who are the winners and losers in sort of 50 years' time? So Scott, can I start with you?
Sure. That's a pretty tough question, to be fair. I think, look, there's a lot of appetite, particularly in this sort of space, to think that blockchain, DLT, whatever it is, will be the ultimate technology for financial markets. And maybe it will be, and maybe it won't be. I think if you're a capitalist and you believe the better technology wins, then it will win in some cases. I think for bits of the market, it is a better technology than what we've got today. But it's got to get over the investment hurdle, and that's not a guaranteed outcome. So I think, to really sort of say, what does 50 years look like? It really depends on what the market appetite is for the types of products that fit on this technology. And the problem is, it's still a conversation about the technology. It's not a conversation about the market. So the first thing that has to happen is It just becomes a conversation about the market, and this is another tool in the toolkit that we can use in a way to solve problems for the market. Now, whether that be liquidity challenges, whether it be dealing with capital, whether it be dealing with distribution to a wider set of investors, whether it be lowering the cost of servicing assets, whatever it is, like that's the conversation that needs to happen first. If this type of technology versus another technology decides to run with blockchain, DLT, digital asset type structures, then great, like it'll become a really big bit of the market. I don't believe at any point in the future that there will be a single individual blockchain or distributed ledger that becomes the market. I think the best we can expect is there might be components of a single jurisdiction that run either fixed income or other types of assets in that jurisdiction on a specific type of technology. And maybe we'll see a few jurisdictions use similar technology protocols. And the reason for that is like just general primacy of your own jurisdictional financial markets. You know, as soon as you give up some of that autonomy of the rule base, or you connect to different jurisdictions in a way that's more open than today, you're also giving up control, and you're giving up the opportunity to, not in the happy path, because when it's all wonderful, it's amazing what you can do. When it breaks, which it does, and we've seen like there will be more financial crisis, you want to isolate your market. And so that's a really long answer to say in 50 years, blockchain will be part, and digital assets will be part of the market. It certainly won't be all of the market. It will still need some sort of connection to the rest of the market, because assets don't live by themselves in isolation. And I don't see a single individual winner in that space. And just to finish it off with something slightly controversial, I also don't see at any point there will be significant, and we were just talking about this, I don't think there'll be significant scalable risk on public, non-controlled blockchains at any point in the future, because we'll never get past investor protection rules. That doesn't mean they won't exist, and it doesn't mean there won't be large, like there'll be, you know, pools of assets on them, absolutely. Do I think that they will see trillions of dollars of assets under management that are held in an asset manager go on to an uncontrolled technology layer? Absolutely not, because there's no one to sue.
I mean, it's an interesting point as well, because we saw just actually, I think it was a few weeks ago, the BIS published a paper on the risks that they saw identified with permissionless ledgers as well. And so, again, still remains a point of regulatory focus as well. And also noting, you know, your point about the jurisdictional control. In my opening remarks, I mentioned where we've seen all of the bond issuances, and it's Asia and the EU, because that's where firms have found the clarity. And so I think it will be very interesting to see how these markets continue then to evolve, and in which jurisdictions are able to sort of take that.
Just so we have issued in the US.
In the US, yes.
And we're going to do more.
Sorry, it was majority, not all, but majority. But
I don't even think that you have to wait 50 years. If you're talking peer-to-peer, right, in its existing. Okay, I don't even think that we need to wait 50 years. You can think 5 years. If you're talking P2P in the current state, regulators are going to shut it down. It's very simple as that. Because, okay, let's say you go to point zero, where all the deputy governors of different central banks and stuff like that, you talk to them, DeFi, peer-to-peer and stuff like that. No one likes it, right? Because to them, it's that, I mean, to be fair, right? To them, if it's DeFi, if it's P2P, it all resulted because it was a rebellion out of the normal traditional systems. A lot of centralized exchange could not get banking rails. They couldn't do things smoothly. So therefore, they created this rebellion, right? I can do peer-to-peer payment, I can do DeFi, no KYC, things go in immediately. So in an existing stage at this point in time, all right, I don't think it's going to survive that long from a regulatory perspective. Centralized exchange is the focus of regulators today. You look at all different jurisdictions, a lot of regulations has been put around centralized exchange. They have not started to move at DeFi, peer-to-peer, because it's a bit small at the moment. So what they want to do is make the centralized exchange regulated. But then at the peer-to-peer stage, that's where a lot of on-ramps are happening today. That's where money gets in, right? But what they are doing is that it's done between two un-KYC person. I'm transferring you money, you transfer me a stable coin without any regulations. It's not regulated in that space. It will be eventually just cut off, squeezed off.
Jump right in. Is your mic on?
Hello, better? No? Okay, thanks. Yeah, so I guess a few things. So one is just, look, any player, exchange or otherwise saying that, hey, we've already won the market, is out of their mind, right? We are just so profoundly early just in terms of kind of where this technology is. The good news is that, we're still on pace at the same level of adoption of where the internet was, if you just map out the log charts. But if you just kind of extrapolate it, right, there's probably another, 10 to 15 years where you really start to get to maturity. And to your point, like when we stop talking about the technology. There was a time when we used to talk about, modems and, what dial-up were you on and all of that. And eventually, as the stacks got built up to the point it was performant and the average user really didn't need to care, or that hopefully the average investor will never need to care, I think that will, make way for what a kind of paved path should look like. Now, I think that to the point of P2P, and perhaps we can even sort of define what that really kind of means in this context, I do think, yes, that P2P on-ramps, like if you look at like Paxful, for example, like they're capped, right? Like they're not going to get beyond a certain scale because there is just way too much risk. But if we're just talking about like on-chain P2P transactions, I think there's a way to thread this needle, and there's a lot of work being done already where you start out with open networks where you get all the benefits of scalability, all the R&D work that's being done, the security budgets that are being allocated to these blockchains. You have levels of assurance while having global shared state, but having permission operations and protocols and networks on top. So I think there will be some way to, that this you start to get like the benefits of both, where you can do some things that are composable, you can kind of ship at like technology speed, but you can protect at financial services kind of controls and the level that you want this to be. So I'm very optimistic about where everything is going. I think there's a ton of experimentation. I think, Scott, as we were also talking about, the big thing for this industry to me at the moment is how do we start getting beyond pilots and POCs to kind of starting to see real commercialization beyond stablecoins. And the green shoots are happening, but there's a lot of creative energy, developers, investment capital, credible stakeholders that are throwing their hat in the ring that I think we're on the right path.
So your sort of 50-year vision then is a sort of meeting in the middle where we have the advantages of both.
Yeah, I think the winners and losers here really will be, look, this is a massive sea change, and whosoever can adapt. So with incumbents, if they really kind of pull in the innovation into their walled garden, or for startups that really kind of break out of the mold, and kind of get to escape velocity, I think there will be multiple winners because this is an ecosystem at the end of the day. And to the point is you have to deliver value to your end client, to your end investor in a way that's differentiated and a step change from what we have today. If we cannot bring these pieces together as an industry, we will all have collectively failed.
Agree, completely agree. So can we also go to another kind of piece of this, Daniel, thinking about security tokens and traditional assets? Where did they meet in this sort of blending of new and old world?
I think security tokens is just simply a representation of what you have traditionally, right? So traditionally, as you know, that most of your securities are traded in centralized exchanges using a lot of database to prevent double spending, to ensure that all the transaction is properly recorded, and then you have a clearinghouse to do settlement. That can be easily replaced by a blockchain. So like if you look at most exchanges, why is it so it's easy for someone to start up an exchange in this sense using blockchain, whereas 10 years ago you couldn't do that, and that's because the cost of clearinghouse is very expensive. One of the most expensive things to set up a traditional exchange is the clearinghouse, right? That's the central depository where other things are kept. A blockchain can replace that easily. So it just makes the transfer very easy. So that's why tokenized money becomes important, whether it's tokenized deposit or stable coins. Because what happens is that if I sent you an asset that's represented by a token, I need to have that payment in a tokenized form as well. Otherwise, it will be like the settlement in the traditional sense. Like today, you have T+2 settlement, T+3 settlement in the traditional world, because your money moves one side and then your settlement is done on a different system, right? So delivery versus payment actually only happen like 2 days after the transaction. So in real-time transaction, and you want that you can do it with security tokens today, you need tokenized money to actually represent the payment when you transfer that securities. But the underlying securities remain what it is today. Current laws would govern it. It will be the same product as what it is. It's just that the delivery and trading mechanism become a lot more efficient. Right?
Yeah, absolutely. And Scott, do you have anything to add on that? I know you guys have done a lot of work around this as well.
Look, the principle's the same. Like, you know, if you use the same legal construct, it's the same security. It's just another ledger. Well, I put an SAP, or I put an Oracle, or I put it on Broadridge, or I put it on some sort of DLT. Who cares? It's the same thing. It's just a record of ownership that has some characteristics around it. Like, I think we don't want to change the underlying legal sort of structure of any of those instruments. It's a mechanism for transition of those in a way that maybe has got some benefits over, in certain circumstances, benefits over the current.
Sorry, go ahead.
I was just going to say that there'll be practical issues that you see in security token offering nowadays. That's because a lot of the token offerings are done in a way where instead of doing a full prospectus for that offering, is usually done as a limited offering. So they will actually issue it under some sort of safe harbor, which means that the people that can purchase it becomes very limited. You only have the professional investors, the accredited investors that actually can deal with it, and therefore the people that can trade into this asset class become very limited. But if it's issued according to the same way you do traditional asset, it will be just as good as any equities that you buy today.
And I think let's unpick this a little bit further. So thinking about, you know, exchanges, capital markets, and where are those big pools of investors actually at? And especially those who may not be so tech savvy. So Anthony, maybe you have some views on this, like thinking about asset managers, for example, private banks. How do we bring them in? And is there a way to do this in a way that they're comfortable with and makes sense and that they actually see the value in it?
Yeah, indeed. And worth unpicking peer-to-peer for a moment as well, because I don't think this world is going to evolve where you're going to unlock peer-to-peer between an investor and the issuer, the asset directly, right? Where are the assets? Where are the investors? Okay, well, if you move beyond the world of crypto, which is actually quite small and quite niche, and you talk about the tens of $trillions that are in the global real estate markets across not just public securities, but private securities, etc. Where are those assets? Where are those investors? Well, those assets around the world, those issuers are working with and represented by major banks, asset managers. Where are the investors? They're represented by major wealth managers, asset managers, hedge funds, private banks. So the way we think about the world is it's about peer-to-peer between those regulated entities, those institutions that have the pools of assets, have the pools of investors. So for us, it's how do you connect those large pools of assets, those large pools of investors. So we see that happening through a peer-to-peer paradigm, such that those investors and assets can meet through those representatives. We think that's the only way, really, that it can scale effectively at a global level.
But that's not exactly peer-to-peer because it's intermediated, right? There's always an intermediary in between, like a private bank or someone that's actually moving the private equity. Same as even securities tokens today. It's distributed by a private bank. That's not peer-to-peer. That is intermediated by the private bank.
Do you want a world where you just have every investor exposed directly to the asset?
No, then it's not peer-to-peer anymore. So
if you
about peer-to-peer, it is actual peer-to-peer. And that's why I say in 5 years it's going to be regulated. So the only way to do actual peer-to-peer is you do whitelisting of the peer-to-peer. Today what you're doing is not peer-to-peer. It's intermediated by private banks. So if I'm doing a security token today, what I'm transferring is a capital market product. The capital market products that's going from me to you is not directly to you. It's intermediated by some financial institution. The private banks actually the ones that are actually doing that intermediation.
When you,
It's
So
actually
maybe
held
that's-
by someone.
when you whitelist, who's doing the whitelisting?
No, that's why I'm saying there's no whitelisting today. I'm talking about in the future, that's what's going to happen. What is happening today is intermediated. So what is the actual peer-to-peer is not something that regulators actually liked. If you're talking about actual transfers, right? So once you are doing an actual transfers of tokens, that's not something that it's...
So I think-
Because if now I can do peer-to-peer, right? I can send him, I can do send money to him, he sends me stablecoin, right? No KYC, it's just
And I think this maybe is
that's a
the
true
difference
peer-to-peer
between
transaction, right?
peer-to-peer at the individual level and then peer-to-peer in terms of what Onera is doing at the institutional level. Maybe this is a good time for you to unpack that a little bit, Anthony.
Correct, because we're kind of talking same and different, right? In the world of securities, there is a lot of regulation for a lot of good reasons, and that will always be there. You know, if you've got a regulated security, you need somebody who's responsible for the record of ownership of that security. That's a good thing. That protects the assets. You want investors that are protected by their custodians. All of these things will persist because they're a good thing for the stability of the market, protection of investors, regulation around that. I don't think of those people who are responsible for record of ownership of securities or representing investors as intermediaries in the sense of creating an efficiency in the market, right? We're all looking for this new efficient digital world, digital rails. What you want to be able to do is connect those entities peer-to-peer so that you don't have unnecessary intermediaries in a chain. You want an effective chain. Once you can create a digital chain from the asset, the issuer, all the way through to an ultimate beneficial owner, those who are benefiting from the asset. Once you have that digital rails, you can drive efficiency and you will drive out intermediaries that are not adding value. And you will have intermediaries that are there because they add necessary and important value to the transaction.
I want to let Hassan come in on this too, because you looked like you had a point to add.
Yeah, so I think just a couple of things on this dialogue, right? So one, definitely I'd say that the way I think, or my spicy take on this is that for private investments, we're never going to democratize them. We're going to liberate them. So, you know, there's absolute kind of value being created by eliminating multiple reconciliations and even things like atomic settlements, which really kind of allow for that kind of pure transfer to happen in a way that's pristine and auditable. I do think that that's kind of within the regulatory construct that will scale over time. I think for things like, I think the benefits are, you know, you can start lowering kind of minimums. You can start letting more high net worth and accredited investors participate. So it does sort of increase the TAM somewhat for these fund managers, but it's not like, yeah, it's going to be a free-for-all and anyone can sort of participate at any time.
And I think we all agree on that. We're not moving towards a free-for-all
But then what's
world.
the difference between today?
So the last thing I just want to say on this is that I think the one core primitive that also I'm very excited about is decentralized identity, because with these assets, the rules can move with them on chain. And so as more kind of constructs that really, you know, allow for fraud signals and, you know, some level of KYC signals, I don't think reliance will ever go away. Those will allow for processes just get much more efficient and lubricated than the way that things are today.
So like, you know, today you have multilateral trading facilities, dark pools, you connect different dark pools and you transfer that. That's not peer-to-peer. It's intermediated by the dark pools operator. That's not true peer-to-peer. Real peer-to-peer is always the end beneficiary to end beneficiary. What we are talking about now is still intermediated.
Scott?
So it's not peer-to-peer in that sense.
So, I mean, and this is my perspective, not JP Morgan's perspective.
It's all right. We're getting into it on this panel. Go right ahead.
But the way I'm thinking, this feels to me when in a peer-to-peer context, it's more platform to platform. And certainly our view is, and this, okay, the regulation says one thing, but the regulation says that thing because that's about the management of risk in a market that has required those regulations to make sure we can manage that in a way that's effective for that market. And, you know, things such as, to your point, like credit disintermediation between the issuer and the investor is an important function that actually investors want and issuers want. I don't think that's going to disappear, but the way I understand sort of a narrow role, in peer-to-peer is less about removing each of those individual components, but maybe linking them up in a way that all of the steps that happen today may not have the same level of value in a future market structure. And so rather than being like disintermediated, it'll become self-evident where there's less of a role in some of those steps. And I think I'm with you. I don't see a market where it's like investor to investor or issuer to investor. I think there'll always be intermediation between those, and that's a good thing, because regardless of what regulation says, that's what we want from a risk standpoint, and taking risk and managing risk standpoint. But I do think there's ways that over that evolution of the market, as you connect platform to platform, whether it be through, to the more sort of newer end stablecoin end of the market and exchanges, or whether it be to the more regulated space, as the right products for the right sort of risk taking in the market become prevalent, then you will see a slightly different model evolve, and then you get a more direct relationship between some of those participants than you do now. And I think that's the sort of piece that fills a gap.
Yeah, I think that it's possible to have it real peer-to-peer, but you need a lot of safeguards. Let's talk about the national identity, how you can use that to do the KYC and whitelist each of them. Then you can do that cross peer-to-peer thing.
Yeah.
So, yeah. So.
And I mean, I think that we will have plenty to talk about in the coffee break and can carry this on, but I do want to pause now just in case, because we obviously had lots to talk about. Is there any questions from our audience for our expert panel? I think we have time for one. No questions? All right, then maybe I will just ask one last and yes or no. So just the question, which was the title of the panel, will P2P and centralized asset exchanges interoperate, yes or no?
Peer-to-peer at an institutional level, yes.
Yes, they will.
Yeah, I think they have to at some point, yeah.
Only when whitelisting, when they are whitelisted.
Fair enough. All right, thank you so much all.